Welcome back, everyone. Next, we have Independence Contract Drilling. It trades on the New York Stock Exchange under the symbol ICD and provides land-based contract drilling services for oil and natural gas producers in the U.S. The company constructs, owns, and operates a fleet of pad-optimal ShaleDriller rigs that are specifically engineered and designed to accelerate its clients' production profiles and cash flows from their most technically demanding and economically impactful oil and gas properties. Please welcome its president and CEO, Anthony Gallegos. Welcome, Anthony.
Well, thank you, Anna. I really appreciate the opportunity to present to everyone today. I want to say in advance, thank you to everyone for taking time to watch this presentation today.
All right, take it away.
All right, great. I have a few slides here that I want to walk us through today to help tell the story of who we are and where we are, and most importantly, where we're going. I do want to point out that in the course of making this presentation, I will be making some forward-looking statements, so I would refer you to the documents that we have on file with the SEC regarding those matters. So for those that may not be familiar with who we are, we trade on the NYSE. We are the only publicly traded pure play owner of super spec rigs. And like I said, we do trade on the NYSE. What I mean by pure play super spec, all we do is own and operate pad optimal super spec rigs. We're not into any other service lines or product lines or anything like that. So as I go through this presentation, there are a few things that key facts about ICD that I'm going to want to point out. We have the best in class drilling fleet. We operate in the most important unconventional basins in the United States. We are the recognized leader for service and professionalism, having been ranked #1 for service and professionalism for 5 years running. We have a premier and evolving customer list, which I'll show you here in a second. The market for pad optimal super spec rigs is as tight as I've ever seen. Our margins, our EBITDA, and our cash flow are rapidly increasing and are poised to accelerate even further as we continue to reactivate rigs and undertake some conversions of our 200 series rigs to 300 series specifications. And we recently completed a refinancing of our corporate debt earlier this year, which has set us up now to untap the value that's embedded within our company. So at the end of this presentation, I hope to tie all this together and show you how all of this leads you to the fact that ICD is one of the best investment opportunities out there for exposure to U.S. equities. We hosted our third quarter earnings call earlier this month. You see the highlights here, and there is a replay on our website that you can go to. So let me summarize our rig fleet here quickly. We are marketing 26 rigs, and they're all pad optimal super spec rigs. So when you hear people talk about the rig market being tight, it's this type of rig that they're referring to. Our rig fleet is broken down into two classes of rigs. There's our 200 series rigs and our 300 series rigs. So we have the right tool depending on our customers' particular exploitation or development needs. Our 200 series rigs, for example, are very fast moving rigs. Our 300 series rigs are set up to undertake long laterals and things like that. Drilling rigs can work in both oil and gas basins. They are mobile. And while we work today exclusively in the Permian Basin and in the Haynesville, we have work in other basins such as South Texas and Oklahoma. And we do have an increasing presence in the Haynesville, which, as you probably know, is seeing increases in demand for U.S. natural gas. I would highlight also that back in August, we announced a conversion program where we can convert our 200 series rigs to 300 series rigs. That's very strategic for us. And here in the month of November, we have completed one of those. So rigs that meet the 300 series specification are in the highest demand today or in the shortest supply. These are the rigs that secure the best contracts. They work for the highest day rates and work for the most demanding customers. Expanding this portion of our fleet is very, very important to ICD and our stockholders. It's been a strategic focus for us going back as far as 2018. that we strategically move our fleet toward the 300 series specification. These pie charts here summarize the evolution to where we are today, which is being able to market 96% of our fleet with 300 series specification now. So to put it into perspective, as a percent of any U.S. land contractor's rig fleet, 96% would be the highest percentage of their fleet having 300 series specification. This is one more fact that differentiates ICD from your other companies out there in the U.S. land space. So the 300 series conversion, as I said earlier, has tremendous strategic importance for us as the market evolves to bigger pads and deeper and more complex wells. But it also has huge financial implications for ICD also. And this slide illustrates how the evolution of our rig fleet toward 300 series specification is driving substantial and accelerating margin and cash flow growth. As you can see here, compared to the pre-pandemic period, we've already doubled the number of 300 series rigs operating in our fleet, and our margin per day has already materially surpassed pre-pandemic levels, and we're just getting started. Going forward, our 300 series penetration is going to increase with additional planned rig reactivations and the 200 to 300 series conversions, which is going to accelerate margin expansion well into 2023 and beyond. If you look at what's already in our 2023 contract backlog today, our margins per day will soon exceed pre-COVID levels by more than 200%. So we work for a wide array of customers. You can see the logos here on the right side of the slide. We've structured our company to work for super majors and large independents. Like everyone, we work for private E&P companies as well, and we thank them for their business and the trust that they put in ICD. This customer focus and strategy creates torque in our efforts to increase rig margins and allows us to tap into the longer-term programs that the larger E&P companies offer. We have, as you can see, a very balanced geographic position in terms of where our rigs are deployed. As you can see, about half of our rigs work in the Permian Basin, the other half work in the Haynesville. So another way to think about that is roughly a 50-50 split between exposure to oil and exposure to gas. I would like to point out that we started this year with about a third of our rigs working in the Haynesville. So you can see how over the course of 2022, how we've grown that presence significantly. I would expect us to continue to target that market as well, because as you probably know, it's a very important resource basin for U.S. natural gas and all the activities that are required to grow U.S. production and U.S. exports. These two basins are the two most important basins in U.S. land, and I think our significant presence in the Haynesville is probably an underappreciated attribute of ICD. So as I mentioned, the market for pad optimal super spec rigs is about as tight as I've ever seen it. And next few charts will illustrate some of those points. So first, I'd like to define what is a pad optimal super spec rig. And there's 5 attributes that you see listed here. Most importantly, however, to be pad optimal, to be able to efficiently and effectively prosecute field development programs today in U.S. shale, your rig must have the ability to walk in both the X and the Y configuration. And I'm proud to say that from the beginning, our rigs have been pad optimal. There's some confusion out there about how many super spec rigs exist. The chart in the bottom right is our analysis. And the theoretical supply of super spec rigs out there is about 620 rigs. And we estimate about 500 of those are working today. So there are about 120 theoretical pad optimal rigs that are in inventory. Like everything else in the economy, however, reactivation and upgrade costs have increased significantly, which is driven and will continue to drive higher day rates as just out of an economic necessity. An important fact here, conversion costs today is ranging between $5 and $8 million. What that means is that drillers need higher day rates above where spot market rates are today if the industry is going to continue to add rigs, which is the current expectation among industry analysts. So In this chart right here, we've attempted to summarize what's driving the substantial improvements that we've seen in U.S. land rig business in this current upcycle. A couple of drivers in particular are the very rapid rebound in super spec utilization since the post-COVID rebound began, which was in August of 2020. And that's been fueled by very favorable oil and natural gas fundamentals globally. The other driver I would like to highlight is what's happened to the DUC inventory, drilled but uncompleted wells. I have a slide here that I'll show you on that. But these drivers here have all pushed industry utilization above 90%, which has helped fuel significant day rate and margin improvement in this cycle. So our industry has been starved for capital for 8+ years. There's been underinvestment in upstream E&P spend over that period. In the new world of capital discipline, our customers reached into their inventory of drilled but uncompleted wells coming out of the pandemic. That was a way for them to easily and cost effectively replace oil and gas production. But as you can see in this chart, that inventory has been depleted. What that means, and both of these factors mean, is that E&P companies will have to drill going forward just to maintain production. And that need is driving higher and higher levels of super spec rig demand. In the U.S., we expect this will be apparent as our customers begin to release their 2023 E&P CapEx budgets as we round out the rest of this year. Super spec utilization, as I said, is very tight. I've mentioned already many of the drivers for this. However, one important development this year is increasing rig reactivation cost. In other words, the easy, cheap reactivations are gone. Now reactivation costs are ranging in the $5 to $8 million per rig range that I mentioned a second ago. The number of rigs that can be easily and economically upgraded and reactivated is very limited. And as you can see in the chart on the right, it's held by just a few number of contractors. In fact, the largest competitor here owns about 48% of the remaining supply, and he will have to spend $8 million plus per rig to reactivate and upgrade his rigs. And that's according to his public statements. So when you look at this, consider this against a backdrop of the industry's expectation for another 50 to 100 incremental rigs to be required over the next 12 to 15 months. And this setup is why we're so excited about our next 8 rig reactivation opportunities. Everything is pointing toward very robust opportunity for ICD to make very strong returns on the remaining incremental rigs that we'll bring out. So we've gone through the market for pad optimal rigs and talked about how tight it is and the drivers for why we think it will continue to be tight for the foreseeable future based upon the macro backdrop that overshadows any issues around U.S. or global recessionary fears. Now I'd like to focus on what all that means for ICD's EBITDA, free cash flow, and earnings. Our biggest drivers are very strong day rate momentum and increases in our rig count through continued rig reactivations. And I want to point out that our cost structure is very scalable. Our business has very strong operating leverage. And what that means is almost all of the revenue increases will flow through to the bottom line as day rates continue to increase and additional rigs reactivate. Now on to day rates for a second. I've already highlighted our 300 series penetration and how it's transformed our fleet. And you can see that in our expanding margins, which this slide illustrates. A couple things I want to highlight as you look at this data. We have a very clear line of sight through the first quarter of 2023 on margins, and margin growth will be substantial. We just reported our third quarter margins of $11,400 per day, but we're expecting margins of between $14,500 and $15,000 per day in the first quarter of 2023. And beyond the first quarter of 2023, our 2023 backlog has embedded expected margins above $17,500 per day. So we're very optimistic about margin improvements beyond the first quarter of next year. We already spoke about our fleet and our awards for leading customer service and how our 300 series rig penetration has transformed our fleet. And Now you can see that in our financial performance compared to our competitors. This slide simply compares our reported margins to those of our 4 largest competitors. And what it shows is we really have closed the gap in financial performance coming out of the pandemic as of the 3rd quarter. And as I mentioned, we have a clear line of sight on meaningful continued improvement moving forward. Again, the current upcycle is the first time we've really been able to market our 300 series rigs across ICD's fleet and to our customers. And you can see what has happened to our competitive position now that we're able to do that. And there are more 300 series rigs to come out. So as that penetration expands through additional rig reactivations, it's just going to continue to drive our margins up. Just a slide here on backlog. So as margins have improved and rig reactivations, the cost have increased, we've begun to layer on some contract backlog, and we'll likely add more as we move into 2023 and take advantage of our customers' E&P programs for next year. But in moving to bringing on more contract backlog, we're not calling the top of the market by any means. We just really think it's a prudent move at these margin levels to increase the forward cash visibility as we continue to reactivate rigs. And we're not cutting price to do this, as this slide will illustrate. The average day rate in our contractual backlogs approximately $35,300 per day, and that equates to margins of over $17,500 per day. This backlog's why we're confident in additional margin expansion in 2023 and beyond, which we've guided to through the 1st quarter of 2023. So now that we've discussed our fleet and our leading customer service and our clear line of sight on significant margin improvement, I want to try to answer the question, what does all this mean for driving free cash flow and value for our stockholders? I'm going to try to illustrate this in the next couple of slides. Let's look first at what ICD will be able to generate in terms of EBITDA and free cash flow. So we'll look at some EBITDA scenarios here. And what this slide simply illustrates is what our indicative EBITDA could be across various operating rig and margin per day levels. I want to point out that these levels are based upon what we're seeing today. So to put it into perspective, we have 20 rigs contracted, should have 22 in operation by the end of the 1st quarter or very early 2nd quarter of next year. And we'll be looking at possible additional rig reactivations beyond that. And the margin levels, 12,750 is the midpoint of our fourth quarter guidance. 14,750 is the midpoint of our 1st quarter 2023 margin guidance. And the $17,500 per day margin level is what's already embedded in our 2023 backlog. And what you see in this chart is very meaningful improvement in EBITDA. If you think about where we are right now and where we have a clear line of sight, the blue bar represents margins that we've guided to in the 1st quarter of 2023, and we expect to exit that quarter with approximately 22 rigs contracted and working. And of course, we want to turn that EBITDA and growth into free cash flow. And this slide illustrates how much free cash flow ICD could generate. This illustration assumes margin consistent with our 1st quarter 2023 guidance and assumes no further improvement, which I think is a very conservative assumption for this purpose. The dark blue bar represents maintenance CapEx. The light blue bar represents growth CapEx associated with rig reactivations and 200 to 300 series conversions. And the dark green bar represents free cash flow after cash interest. The light green bar, for those interested in unlevered free cash flow, represents our cash interest. We are assuming in this illustration that we pick interest under our convertible notes through March of 2024, and as we grow our fleet to 26 operating rigs. So in sum, we expect this EBITDA expansion to generate meaningful free cash flow over the next few years. And this slide illustrates the type of cash flow we believe ICD is capable of generating. So how does this EBITDA and free cash flow within ICD's capital structure, how does it play out in our ability to reduce debt and return value to shareholders? the refinancing that we completed in March of this year allows us to untap hidden value. That refinancing enhanced our liquidity. It provided capital for reactivations. It addressed the refinancing risk that we faced at the time, and it provided a pathway toward eventually delevering our balance sheet. In terms of our capital structure, we have about $170 million face amount of convertible debt that's outstanding. The conversion price is out of the money at $4.51 per share. The debt matures in March of 26, and we have the right to pick interest for the entirety of the note term. But our plan would be to only do that through March of 24 when we're spending growth CapEx to reactivate rigs. If we decide to not reactivate all of our marketed rigs, then that would reduce our need for pick interest for as long as we've guided. We are, of course, mindful that pick and interest means more convertible debt and potential dilution. So we do consider that as part of the reactivation cost when we're deciding whether a rig reactivation makes economic sense. There is a slide in the appendix to this presentation that illustrates why we think the economic value of rig reactivations today far outweigh the economic cost of picking additional interest. Our long-term goal is to repay the convertible notes with free cash flow or to eventually complete a regular way refinancing of our debt when that window opens up for us to do that. This slide illustrates the progress we expect to make in reducing net leverage ratios over the next 3 years. It's pretty simple. We'll be increasing our EBITDA and free cash flow and building cash, which will allow us to meaningfully reduce our net debt as we move more towards the refinancing window. I'll point out again that this is based upon the same conservative assumptions from the prior slides as far as using margins based upon our first quarter 2023 guidance. So we don't need the notes to convert to meaningfully reduce leverage or repay or refinance our notes. To the extent they do convert, then that cash would be available for return to our stockholders, for example. This slide right here illustrates how much of a discount ICD is currently trading at on an asset value basis compared to our public company peers. When investors talk to us, most are interested in the company's enterprise value based upon operating super-spec rigs, as well as valuation based upon EBITDA or free cash flow multiples. The next couple slides I'm about to go through will frame how we view ICD's value proposition in two respects. And one thing I want to point out as I go through these next few slides is we don't know how much of our convertible debt will actually convert. So we've assumed that we've assumed the most conservative outcome, which is 100% of them convert. So we do believe that ICD trades at a meaningful discount to our public company peers on an EV to active super-spec rig basis. Our competitors trade at approximately $19.5 million per active rig, and as you can see, we're well below that. This chart illustrates our rig valuation on both a converted and an as converted basis. And if you assume full conversion of the notes and a stock price of $6 per share, ICD would still trade at a significant discount to these peers, somewhere in the range of 20 to 25% at $6 per share. So there's a lot of value available to our stockholders as we move toward closing this gap. I have two additional ways for you to consider how cheap we currently trade today and quantify the opportunity that's in front of us as we close this valuation gap. This chart illustrates ICD's indicative share price on a fully diluted basis, assuming full conversion of the notes as we reactivate drilling rigs and pick interest for 2 years. And what you see is there's meaningful upside to our current stock price. And again, this does assume 100% conversion of the notes. I already walked you through our debt reduction slide. If full conversion did occur, then we would have excess cash that is not even considered in these illustrative stock values included in this chart. That would be upside from these numbers. The overall point here is on an asset value basis, we believe ICD represents one of the best investment opportunities in the oilfield service space today. I think it's important to note that the value dislocation not only exists with respect to asset values, it also exists with respect to EBITDA and free cash flow multiples, which this slide illustrates for you. Most of our competitors are trading at multiples of around 4.5 times 2023 EBITDA. We're well below that, even though our margins are on par with or exceeding their levels. This slide simply illustrates across various rig margin and operating rig levels what ICD's share price could be based upon different EBITDA multiples. And what it shows is there's some real opportunities to close the valuation gap with our public company peers, even utilizing very modest EBITDA multiples. ICD is undervalued on a fully diluted basis based upon where we're trading today. And again, this assumes full conversion of the notes. The excess cash, if there was excess cash, is not reflected in these share values. It's simply upside from these numbers. So as I move to this last section of the presentation, I want to briefly touch on our efforts and role involving ESG at ICD. At ICD, we've always been focused on ensuring that we meet society and all of our stakeholders' expectations around ESG. We've always been forward-leaning on all these fronts. For example, from the very beginning, our rigs were engineered to minimize loads, to be very efficient, and to utilize dual fuel capability. On the social side, we've always been focused on giving back to the local communities where we operate through initiatives like our annual Santa's Roughnecks campaign, which is underway now. We're also focused on maintaining a diverse workforce, not just in the office, but on the rigs where the real work gets done within ICD. And on the governance side of ESG, our board has worked to ensure that management's goals and initiatives are aligned with all of our stakeholders, not just our stockholders. Regarding ESG, so many people want to focus on the supposed negatives associated with what we do. I want to highlight one of the many positives. I've mentioned our presence in the Haynesville. The Haynesville market is a gas basin and is a big driver behind the United States' increasing ability to satisfy growing global demand for natural gas through LNG exports using produced clean burning natural gas. I mentioned earlier that we have 50% of our rigs working in the Haynesville. And when you compare our fleet exposure to clean burning natural gas and compare that to our competitors' exposure to clean burning natural gas, once again, you see that ICD stands out above our competitors. At the rig level, we do a lot to reduce greenhouse gas emissions. All of our rigs are dual fuel capable, which allows our generators to use clean burning natural gas. Our rigs can operate using the electrical grid, allowing us to generate zero greenhouse gas emissions at the pad site while operating our drilling rigs. And like I said, we will continue to look for ways to continue to help society's efforts to address these matters. So as I conclude this presentation, I'd like to summarize a very compelling case for being an ICD investor. We have the youngest fleet in the industry that's outfitted and equipped in ways that maximize our customers' efforts to exploit U.S. Unconventional resources and pursue the industry's ESG efforts. We have favorable market fundamentals in place that are driving very strong rig demand. We have rapidly expanding margins on par with or exceeding our larger public competitors. And we have an expanding 300 series utilization and more to come through additional reactivations and conversions. As I illustrated, there's meaningful stock price upside based upon both asset values and cash flow and EBITDA multiples. So these are some of the very compelling reasons why we believe ICD is one of the best, if not the most compelling investment opportunity in oilfield services today. Our ticker symbol is ICD, and we trade on the NYSE. I'd like to say again, thank you for your interest in ICD. Feel free to reach out to us using the contact information that's included in this presentation. With that, Anna, I'll turn it back over to you.
All right. Great job, Anthony. Okay. Now, excuse me, you mentioned you have 20 rigs contracted and expect your 21st rig to come out in January or February. So how are you thinking about additional rig reactivations after that?
Appreciate that question. Like everything that we do, we'll look at the market and what the expected return on the reactivation investment would be. Right now, the timing of our 21st rig is pretty much baked in, but the others, we do have the option to move around at our discretion. Our customers this year, for the most part, still haven't finalized their 2023 budgets, which is a little slower than what we would normally see. or would have expected. So, predicting the timing of rigs beyond our 21st rig is a little harder. A good thing is, though, and I'd point out, is with 20 or 21 rigs running, ICD is positioned still to accomplish all of our financial and strategic goals that I've outlined today regarding EBITDA growth, debt reduction, and especially in closing the valuation gap between ourselves and our larger public company peers. So additional rigs from our viewpoint, Anna, would be nice to haves, but would not be critical. So we can afford at this point to be patient and deliberate in what we do beyond the 21st rig.
Also, you obviously have made a lot of progress reactivating the rigs, and you mentioned your margins are on par or exceeding your larger public company peers currently. So what is it about your rig specifically and operations that allows you to do that?
Look, I think it comes down to having the right rigs and the right people. As I noted, we have the youngest fleet in the industry, and it's all super spec, pad optimal. Head to head in the core basins where we compete, our rigs and people stack up with anybody. I actually think our size is an advantage in that it allows us to be more nimble and able to react to our customers' evolving needs. We aren't in other business lines, as I pointed out, and I think our laser focus differentiates us. And I think the fact that we've received the rankings, #1 rankings for service and professionalism that I mentioned in the presentation also illustrate that we are being very successful in these endeavors.
All right, we have a lot more questions. Let me see if we can get one more in for you from Henrik. How do you plan to close the significant implied value per rig gap between ICD and the driller peers?
Yes, I think it's going to be in our performance, but to me, it's very, very simple. We've got to work safe. We want to make sure that we're with the right customers, and we need to, and we will generate a margin per day that is in line with and hopefully even exceeding that of most of our public company peers.
Great. Well, Anthony, we have more questions for you, but we're out of time. So we'll send them to you so you can answer whenever you can. Thank you so much for joining us on Emerging Growth, and we hope you come back again with some updates.
Thank you very much, Anna. We appreciate the opportunity.
All right. Have a great rest of your day.
Thank you. You too.
Okay, everyone, stay with us. We're going to hop on to our next presentation. We'll be right back.